When a new token drops in crypto, it usually comes with leaks, hype, and a lot of speculation. That's exactly what we saw with Union Build's U token. But now, after months of guessing, the official details are finally out. The Union Foundation has laid everything on the table in a big post, an X thread, giving us the clearest picture yet of how U will power its network, how it's structured, and how the community is reacting as Union moves closer to its mainnet launch. At its core, Union is a zero-knowledge interoperability Layer 1 blockchain. That's a mouthful, but in practice it means Union is trying to solve one of the biggest headaches in crypto: fragmentation. Today, blockchains are like isolated islands. Ethereum, Cosmos, Bitcoin, and the rest all speak different languages. Union's approach is to use zero-knowledge proofs and light clients to connect these worlds directly, without depending on centralized relayers or clunky multi-sig setups. It's built to pass messages, transfer assets, and even move NFTs across chains. Under the hood, it runs on a tech stack with components like CometBLS for consensus, Voyager for relaying data, and Galloy for generating proofs. Put simply, it's designed to be fast, modular, and developer-friendly, supporting environments like Solidity, Rust, or Move. The U token is an ERC20 asset on Ethereum, and it's not just a placeholder. It's the fuel, the security, and the governance layer for the entire network. Union designed U so that its demand directly ties to real network activity, whether that's verifying proofs, relaying transactions, or securing the chain. Think of it as the bloodstream of the ecosystem. Utility-wise, U plays multiple roles. First, it's the gas token. Any action on Union, whether you're updating a light client or registering an asset or submitting a proof, requires U. The network runs on a dynamic fee market, so tasks can be prioritized with higher fees, much like Ethereum's gas system. This naturally ties the value of the token to usage. Second, it's a security token. Validators need to stake U to participate in consensus, and holders can delegate their tokens to earn staking reward. What's unique here is Union's integration with the Bitcoin Supercharged network, which adds another layer of security through Bitcoin restaking. That means security less reliant on inflating U rewards, which is something we've seen become a problem in other chains. Third, U is a governance token. Holders get to vote on proposals, things like fee structures, protocol upgrades, or treasury spending. One interesting design choice is that governance can happen cross-chain, starting with Ethereum through liquid-staked versions of U. That way, users don't have to constantly bridge tokens around just to participate in decision-making. On top of that, U finds itself integrated across apps in the ecosystem. Dexter for decentralized trading, Escher Finance for liquid staking, Stargaze for NFTs, and more. Early stakers are also being incentivized heavily, with rewards projected as high as 120 to 140% in the first year, tapering down as the system stabilizes. U has a genesis supply of 10 billion tokens, with an initial circulating supply of just over 1.9 billion, or 19.19%. That relatively low float compared to a total supply is intentional, with allocation structured to keep the network sustainable long-term. Inflation begins at 6% annually, but decreases by 10% each year until it bottoms out at 2%. Rewards for validators, contributors, and investors come with cliffs and vesting schedules, meaning no one can dump early. As for allocations, the community and ecosystem get a combined 26%, with community incentives alone at 12%. That's where testnet participants, Genesis drops, and future programs like XP conversions come in. Strategic investors get 21.4%, but none of those tokens unlock at launch. They're locked for a year, followed by staged releases. Core contributors and advisors receive 20%, with a 3-year vesting plan. The foundation takes 20% for operations, and 12.5% goes into a DAO treasury controlled by U holders. For the most part, the community has responded positively. On X, users are calling the tokenomics solid and bullish, pointing to the fair distribution of incentives and the 19% circulating supply as signs of a healthy design. People are especially excited about how U ties into Bitcoin restaking and how the ecosystem partners like Babylon and Tower are helping to build out early liquidity and staking options. Of course, there are always mixed feelings. Some feel that the community rewards could have been higher, or that emissions could create short-term sell pressure. But the general tone is that Union is delivering something meaningful, especially after months of speculation and earlier leak. Looking ahead, the focus shifts to the token generation event, eligibility checkers, and the rollout of mainnet staking. With Union already logging over 275 million transactions on testnet, the Foundation has proof that the system can handle scale. Nearly 60% of the supply is directed towards users, builders, and governance, which signals long-term sustainability. The bottom line is this: Union isn't just launching another layer 1 with another token. It's trying to solve one of crypto's deepest problems, connecting blockchains without central choke points while aligning token demand directly to network activity. The U token is the backbone of that system, and the early reaction suggests the community sees it as more than just another speculative asset.